Has the world really factored in future copper demand, and perhaps should the price be higher? Plus, find out why today's guest said you should ignore grade and look at the margins. I'm Shay Russell, your host for Drilling Deeper, and joining me today on today's episode is the Managing Director of Alma Metals, Frazer Tabeart. Frazer, it's fabulous to see you, and thanks for being here.
Thanks, Shay. Good to be here.
All right, Frazer, let's kick off today's conversation with some of the macro points around copper. I started talking about the importance of copper way back in 2019, but I feel like only in the last year or two it started to reach retail investors about a looming supply shortage of copper. And we'll talk about supply and demand on sort of as two separate things here because they are both very different. Let's start with this shortage, though. What do you know about the copper shortage, and is it as serious as some of the headlines make it sound?
Yeah, we think it is. In fact, probably some of the headlines are maybe even sort of downplaying some of the shortages because obviously the key copper suppliers don't really want to be talking up a bad story. But what we've seen in the immediate short term, and this goes back almost 2 years now, is some of the world's largest copper mines have had sort of major incidents, whether they've been, seismic events which have led to flooding underground or, in some cases, extended industrial action or, community opposition, in some regards. So a large number of the world's sort of top 10 copper producing assets have been severely sort of constrained in the last, anywhere from 2 years to 6 months. They're big assets and it takes a lot of money and a lot of time to get those back to full production. So we're often seeing then sort of 6 month, 9 month, 12 month sort of press updates going, we're almost there, but we haven't quite fixed it. And yes, each one of those just takes a little bit of supply out of the market. And the copper market, is sort of very, very tightly balanced in that supply demand scenario. So any shortfall on the supply side puts it out of balance very, very quickly. And you see that reflected in quite rapid price changes. And that's what we started to see sort of, I guess, late last year. And then, particularly, in the first couple of months of 2026, there's a very strong response in the copper price to, some of the extensions of these problems on the supply side. And, something we've been talking about for quite a while. But I think that narrative now is starting to get a little bit better known in the broader general market, and that's why I think there was sort of the fun and games that's going on in the Middle East right now. People were really starting to see copper as one of the sort of leading commodities for 2026 and 2027.
You mentioned the big assets there that you're talking about now. We've probably got quite a few new investors to copper. What are these big assets that you're referring to?
Yeah, there's a number in South America. And these ones are generally the big porphyry copper types of deposits, which are very large, low-grade assets. And they make up probably 65% of global production. Chile and Peru in particular are extremely well endowed with these types of deposits. So we know, for example, El Teniente, which is one of the world's, it's probably in the top 2 or 3 in terms of size. It's an enormous deposit. They've had some problems with their underground workings caused through seismicity, and that's just taken some of their production offline, and they're obviously have got alternatives there, but it certainly has cut their output a little bit. Chuquicamata, which is another very big one in Chile. Again, top 5 largest copper deposits in the world, been mined continuously for probably 100 years. They're going through a major transition from open pit mining to underground mining. And it's an engineering challenge when you're trying to do that on that scale. And, they are, well behind the schedule that they originally set. Now, you'll see all sorts of narratives that they're not really behind schedule and blah, 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 but they are. And, so that, again, when analysts look at what their expectations are of copper supply, they've got to take into account how confident are we that the timeframes that, these changes are real. And then another big porphyry copper in Indonesia, Grasberg, they had a major seismic incident last year, which ended up with a slurry and mud rush into their underground workings of tens of millions of tons of material. And that's sort of compromised a lot of their working areas. And that's still not fully resolved. So they're not back to full production either. And Grasberg again, top 10 world-class deposit. So through the world's biggest porphyry copper deposits have had challenges. Then if we look at the next sort of largest category of copper deposits, the sediment-hosted ones, the biggest one of those, or the big one that's operating at the moment, and sort of the new boy on the block was Kamoa-Kakula in the DRC. They've had similar engineering challenges related to seismic events, which have compromised underground workings, and that had a big impact on their production as well. Plus, adding in their case, issues with securing adequate power to actually run their mill at full capacity, and so they've got two types of constraints there. One is sort of externally imposed. The other one is through, for want of a better word, engineering risk or terrain risk, where seismicity can impact these things. So there's 4 of the world's top 10 deposits that have had challenges. That has a big impact on supply, and has a big impact on perception of supply security, in the short to medium term, and that's what is driving the interest in copper prices.
Well, that takes me unfairly to my next question. I'm probably skipping ahead a couple of questions that I had on my list. But, we've got the copper price kicking along at sort of $5.60 per pound, and that's in US dollars for anybody listening. Is the copper price right now accurately reflecting what is likely to be a higher potential recovery price in the future?
We think it possibly still undercooks it a little bit. As I said, those supply constraints are not easily fixed, and even if they get fixed, all they're doing is getting us back to where we were 2 or 3 years ago in terms of the supply. What we really need are a large number of new deposits coming on stream to match the increase in demand. And we haven't talked about the demand side yet, but safe to say, and we will talk about it, demand is increasing, as the world wants to decarbonize and go to renewables, etc. So if nothing else changes, we need more copper. And we've got this sort of perfect storm of supply constraints, and then any new copper deposits coming on stream, they're taking longer and longer to permit. They're in increasingly difficult areas from an engineering perspective. So we're seeing, for example, BHP, working with Lundin, formed that joint venture in the very high Andes, straddling the Chilean and Argentinian border for their new project there. Fantastic world-class project, but it's a 4,500 plus meters. It's an engineering challenge. It's going to take a long time to build the infrastructure, then build the deposit, and then get that into large-scale production. And it's a huge deposit. It's going to produce 500,000 tons of copper a year or more. So certainly world-class. But it's not going to happen overnight. That's many, many years away from production. So we feel that the copper price, firstly reflects the supply constraints, but it's also, to some extent, and this is where it hasn't yet caught up, it has to increase to incentivize new deposits to come on stream quicker. If you want a massive new mine in the high Andes with the huge infrastructure costs associated with building that, the copper price has to reflect that risk and offer a return on it. And so naturally the copper price has to increase to incentivize that new production. So we actually view $5.50 as sort of, I wouldn't say a floor price, because obviously there's going to be, as we've seen with what's happening in the world, there's plenty of room for volatility. But I think long term, $5.50, maybe even $6 is sort of kind of where we have to be, and probably 50 cents to $1 higher than that to incentivize new production to really catch up with where we need to be if we're all serious about reducing CO2 and et cetera, you've got to have more copper. The other thing we haven't talked about yet is AI. And AI is starting to drive huge demand, for data centers, etc. If you don't have any copper, you don't have AI. because it's all copper based, it's all copper backed. So there's these really big emerging thematics, and copper's core to both of them.
Well, let's go into a little bit of the weeds there of what you've talked about with demand, because obviously we've got current copper consumption, and you've put out two of the biggest drivers of future copper consumption that's probably really hard to put an accurate number to. And you're talking about obviously reducing CO2 emissions and AI. What is this? What are these demand drivers from how you see it?
Yeah, I mean, the biggest one is still what copper's traditionally been used for, which is the movement of electricity and the conversion of electricity into motion. So every electric motor, the windings are all copper. At a small scale, if you want to move electricity around your house or around your neighbourhood or around the back end of your computer or your phone, it's all copper driven. As we know, everybody wants a phone. If we're starting to move towards even if you still use internal combustion engines, cars are getting technically more snazzy, much more electronics in cars. That needs copper to make that work. There's more copper wiring in a car now than there ever was. If you add in batteries, then there's copper in those batteries as well. So each new EV has 3 to 4 times the amount of copper than a non-EV would have. If you're going to generate energy, electricity through wind turbines, again, the turbines, the windings are all copper. So not only there's new emerging technologies that are using copper, then there's just the good old fashioned your wiring in your house, all of these things, wiring of electricity in your local distribution network, those are all copper wires. The big high voltage ones, they're aluminium, because copper it's too heavy and bends under its own weight between those large pylons, so you can't use it. But for most small scale movement of electricity, it's copper based. That's the underlying sort of industrial uses. But then you've got all these new emerging technologies, as we talked about, EVs, whether it's battery driven cars or creation of that electricity through wind turbines, and then ultimately any conversion of electricity to motion. There's a motor involved, and copper is still the most efficient metal to use for that. And we just see that getting more and more. Then we've got this AI revolution that's happening now with, and the underpinning of that are these large data centers, and they just need, an enormous amount of copper in them. It's probably not as much as the renewables, but, it has the potential to add 1 million tonnes or more of copper requirements per year. So that's sort of 4 to 5% of current global consumption. So that's significant, when you've got the supply side constraints as well. So you put that all together, and that's what's starting to really drive the copper price. And the only thing that sort of put a little bit of a dampener on it in the last 3 or 4 months is just the geopolitical uncertainty in the Middle East. And that's a short-term thing, right? That's going to fix itself one way or the other, and then the world moves on, because it kind of has to. So we're taking the view, long-term fundamentals are what drive businesses, and particularly when you then look at the business that we're in, which is to try and develop a very large-scale copper deposit. You're looking at deposits here that have lives of 20 to 30 to 40 years. So what happens in the Middle East over 2 or 3 months doesn't really have a big impact on your project over that 30 to 40 year lifetime. It's the underlying fundamentals which drive it. And so that's what we focus on.
Well, that is an excellent point to start my next question. I was going to ask you, because you have the Briggs Copper Project in central Queensland, I believe, and it is we're going to go into some of the positive geological attributes of it shortly. But, you've obviously been kicking around the industry for a while. What incentivized you, or what drove you to go exploring for copper and hoping to develop a major project?
Yeah, it's really, we sort of formed a view as a management team, I guess back in 2019, 2020. And at the time we were doing a lot of work in Africa on power projects. We had a large scale coal project in Botswana, and we were looking at the power dynamics in the region. And the key driver there was the copper industry was short of power. So a lot of people were looking for power to, underpin mine expansions or creation of new mines. So, we were seeing there that, copper was becoming a very strong thematic. I mean, the chairman, Alistair, and I both had long-term exposure to copper through we both worked for large-scale mining companies back in the 90s. A lot of that was sort of copper driven as well. But we saw that in Africa that a lot of the demand was being driven by copper, and the more we looked at copper, the more we liked it, and the harder it was becoming to fund coal projects. So we pivoted the company in 2020, 2021 into copper, and then we also wanted to pivot into low risk jurisdictions, which is why we came back to Australia and focused largely on Queensland with dipped our toes in the water a little bit on copper in WA as well.
Well, let's talk about the Briggs Copper Project because it's got a lot going for it. First things first, let's start with its location and why that is so important for this project.
Yeah, so we're about 60 kilometres to the west of Gladstone in central Queensland. So we're very close to a port. Gladstone, for those people that haven't been there, is one of Australia's great industrial hubs. There are multiple large-scale industries there. We've got 3 major LNG terminals, all exporting gas. There's 2 coal terminals. So those are on the export side. There's also, one of Australia's largest cement factories. And then on the sort of the import side, and this is sort of domestic import, a lot of Queensland's bauxite comes into Gladstone and is then refined into alumina and then smelted into aluminium. And the reason they can do that is it's probably the best combination of a deep water port and low cost power through the nearby Queensland coalfields. So you've had low cost of energy, and obviously the aluminium business is a huge energy consumer. So that's why Gladstone's sort of built up. So we're 60 k's west, and the project's about 10 to 15 kilometres north of sort of a major infrastructure corridor which links those coal fields with the port. So you've got power lines coming from the Collide power station in the coal fields. You've got the railway line which takes coal from the coal fields for export, but also to the Gladstone power station. You've got a major highway. So you've got all the key major pieces of infrastructure that you need to either build a project or maintain a project. And then in terms of our sort of final product, we're going to be producing a copper concentrate on site. All of the logistics pretty much in place now to be able to export that out of Gladstone very readily. So we don't need to build a railway. We don't need to build a road. We don't need to build a port. All of those things are there. And ultimately, when it comes to building the project, that's going to save you tens, if not hundreds of millions of dollars. And compare that, say, with that BHP Lundin project we were talking about up in the high Andes. They potentially, I don't know the precise details, but if you took a generic project in the high Andes, a new greenfields discovery, you're probably going to have to build a desalination plant on the coast to get water up there, a pipeline to get it up there, a road to get your equipment and your people in, and your concentrate out. So you're talking billions of dollars of infrastructure investment before you can even start mining the thing. We're talking here in the case of Briggs probably a few tens of millions of dollars. That's it. Massive saving, and that helps offset some of the lower grades that we're dealing with, because our capital costs are going to be much more efficient. So we should have a very efficient capital ratio here, capital intensity, I should say, in terms of how many dollars do we have to spend to be able to produce a ton of copper.
All right, let's look at the Briggs Copper Project in a little bit more detail, but I'm going to start here with one of the notes that I've got in front of me, and that is deposit geometry. For all of the non-geologists listening, what is that?
It's basically what's the sort of the shape of your ore body, and how does that relate to, say, the surface? So we've got different types of ore body have different shapes. From, say, for example, a high grade gold deposit might be a very narrow vein with high grades of gold in it. That's not the sort of thing that necessarily lends itself to open pit mining, because as you open up the ground, so that the ground doesn't collapse when you're mining maybe 10 or 20 or 30 tons of waste per ton of mineralized material, and you have to pay for the cost of moving that waste. In our case, we're much simpler. Our deposit geometry is like pretty much a vertical cylinder in the ground of mineralization. And because of various other aspects of the project, we have very low cost of mining. that means we can drop our cut-off grade, and it means for every ton of mineralisation that we mine, we have to only move probably less than 1 ton of unmineralised material. And this is a really important point that the market often overlooks. We often get criticised, not just us, but a number of new copper deposits having low grade, because people have got this misperception that grade is king. It's cost management and margin is king, not grade. And the example here is, you may have a deposit up in your high Andes or wherever that's at 0.45% copper, and our grade is maybe half of that. And people go, well, yours is never going to work because 0.45 is better. But the reality is that 0.45, notwithstanding all that extra infrastructure cost, it's also possibly got a strip ratio of 2 to 1 or 3 to 1. So for every ton of material bearing copper at 0.45%, you're moving 2 or 3 tons of waste. So it means in terms of total movement of material, you're actually moving on average maybe 0.1 or 0.15% copper. We're doing pretty much the same. We've got a 0.2 something percent. We're moving 1 ton, let's make it simple, 1 ton of waste for 1 ton of rock. So for every ton of material movement, we're getting 0.15 or 0.12 units of copper. So it's about the same, but we have to move less material, and we've got better infrastructure. So and in the case of Briggs, because we're right at surface, we don't have a thick strip of barren material to move either. So that's what I mean about deposit geometry. It allows us to be very efficient in the mining without having to move much waste on which you get no revenue, versus moving material that's bearing the payable copper. And that's part of the economics, right?
It certainly is. So why do you think people are caught up on this whole grade is king, when quite simply a 1-to-1 ratio of waste versus rock is remarkable, and it's offset by really low capex costs?
Yeah, exactly. I think it's partly historical in Australia. Australia's been very lucky in many regards, particularly in copper, in that it's had a number of large high-grade deposits. I mean, a good example there might be Olympic Dam, which is one of the world's great copper deposits. It's both large and high-grade. Mount Isa, large, very good grades. And there's a number of other deposits in Queensland that have high grade, but they're not very big. So we've had this sort of luxury of being able to mine at high grades, but most of those have either been found or haven't yet been found and are not in production. So you've got to start looking elsewhere. So we don't have a history of mining low-grade copper. You go elsewhere in the world, they do. The Central America, Southern America, North America. There's a large number of porphyry copper deposits there that, even going back 100 years, they broke the mold in terms of mining at low grade. I think Bingham Canyon, in the early 1900s was the first copper mine of any scale to mine at below 1% copper, because it was at surface and the steam shovel had just been invented, so people could start moving massive tonnages of material. So that was quite important. And so you've got to be able to do it.
Now, I know you've been working on the Briggs Copper Project since 2021. So obviously there's been an enormous amount of work that have been done over the past 5 years. But if you could sort of condense what you've done over the past 12 months just to get it to the point where it's at now.
Yeah, so I guess, particularly the last 12 months, we sort of consolidated all of our previous drilling work. So we put a major resource update out in April 2025. We'd also, around about that time, completed the first sort of, full sort of metallurgical test work program on the deposit. When I say full, I mean, it certainly wasn't full, but it was assessing some of the key sort of parameters for the metallurgy. And it was very clear very early in that work that the metallurgy here is really, really good. So we can get very good copper recoveries with very coarse grind sizes, and that means we need to draw less power to get the copper out of the rock, which is an important driver of the economics. Really that was all pulled together then in the third and fourth quarter of last year in a scoping study that we did. So that's where we sort of pulled together. We know we've got a very large resource, so we've got over 930 million tonnes of mineralisation at 0.21% copper. split about 15-20% of that is in the indicated category. The rest is in inferred. We know the metallurgy that we've done is really, really good. We know we've got the good infrastructure that we've discussed. And we know we've got this great deposit geometry, so we have the opportunity for a low strip ratio. So we pulled that all together into a mining study and a processing study, and then looked at the economics of all that. And obviously, under ASX and JORC guidance rules, our ratio of indicated to inferred isn't quite there in terms of being able to publish those numbers. But what they did, and in that context of the copper macro that we were talking about earlier, it gave us huge confidence that this deposit has what it takes to be economically viable, and certainly worth pursuing to the next level of detail, which is a pre-feasibility study, where you're basically effectively going out there and you are focusing on a major drilling program to convert that inferred resource to indicated, because in doing that you're removing most of the residual geological risk from the project. And then, we're going to do much more detailed metallurgy, going down to the next level of detail and start looking at optimization, again, removing any sort of technical risk or processing risk from the project. And then that'll all get pulled together in around 18 to 24 months' time with a major update as a full pre-feasibility study, which is really ultimately taking away most of the risks in the project. I mean, when you go from pre-feas to DFS, you're really just tightening up the tolerances, and you're not really fundamentally changing the risk profile from a technical or geological perspective. You're changing it from a financing perspective.
You've talked about like the pre-feas being sort of one of the next major milestones to work towards. But what's, just to get into the minutiae of it, what's some of that work you're going to do between now and then? Because, these things don't happen overnight.
Yeah, exactly. No, and it is, it's an extended period of hard work. So we're in the process of sort of getting mobilising a drill rig out there to start the infill drilling program, which is basically about reducing that minor inherent geological risk that's still there. And to put some context around that, all things going according to plan, we aim to drill about 40 drill holes this year for about 12,500 metres of drilling. That is equal to what's been drilled on the entire project over its entire history. So we're looking at basically doubling the amount of information in the next 12 months. And then, the next 6 months after that, we'll look to add another 40 holes and another 13,000 metres. That'll allow us to put, the whole deposit into the indicated category, which ultimately, if you're going to do a pre-feasibility study and publish those results and quote a mine reserve, you can only do that on indicated or better quality resources. You can't do it on an inferred resource. So it's all part of a program over the next 2 years to de-risk the project from a technical perspective. So drilling for the next 12 to 15 months, met program in parallel with that, and then we go back to the engineers and the processing guys and get them to come up with more accurate designs for what we're actually going to build, and then we can cost that and then run that through the financial model. And the goal is to deliver that in the next I guess 18 to 20 months, ideally by the end of next year, and that will just largely depend on how successful we are with the drilling programs and keeping our drill rates at acceptable levels.
Look, Frazer, you've talked about a lot of the positive attributes of the project, low energy costs should it go into production, large resource, producing a copper concentrate, and obviously located next to major infrastructure, which sort of removes a lot of the problems that other mines have around the world. But, you've been working on this project for a considerable period of time. What's sort of one of the key factors in your view that a lot of the market is missing about the strengths of the Briggs Copper Project?
I think it's that combination of, well, firstly, let me say, I think people are still struggling in Australia with the concept of low-grade copper being economically viable. So that's an education issue. So it's up to myself and peer MDs of similar deposits. We've got to educate the market, and we can do that by comparison with other projects around the world, which ASX don't like, but you've got to be able to do it to some degree. But you've also got to de-risk your project. So that's sort of been a challenge. But but then when you do get and sit down with people and go through that and go through the combination that we have of, large scale, good geometry, good metallurgy, good infrastructure, and you can start talking about, good margins. Then people can start making comparisons with other similar projects and recognise, certainly in the case of Alma, there's a huge value difference between, us with a $25 to $30 million market cap and companies with similar scale projects at slightly more advanced levels, but not yet in production, that have market caps that are multiples of 5 or 10 times that. So there's a nice sort of delta in the valuations there. And what we're trying to do over the next 18 months is close that gap. Through good work, obviously news flow, and just continually talking to people and educating the market. It's exactly what gold went through 15, 20 years ago. And in many ways, it's not too dissimilar to what happened with iron ore 20 odd years ago. Iron ore went from unloved, maybe making a margin of $10 a ton on costs of maybe $15 to $20 a ton. And then you had, this massive, industrial boom in China, which drove a complete revolution in the pricing and the mining of iron ore. We think copper's in a similar position there. And like iron ore, copper's not yet priced adequately to accommodate that. But it's also, you can increase the cost of copper by 20 or 30%. It's not going to fundamentally change people's view on whether, should they start substituting copper, because there really isn't a cost viable alternative.
Listen, Frazer, thank you so much for your time today. This was an incredibly informative conversation, not just about copper, but also the progress that you are making with your Briggs Copper Project. I really appreciate the time.
My pleasure. Thank you.